Okay, let's unpack this. Have you ever wondered what truly separates those who just do finance from those who genuinely understand it? What does it really take to navigate the complex world of mergers, risk, performance, not just with calculations, but with, genuine insight? Today, we're taking a deep dive into a fascinating document, an examiner's report on advanced financial management. Now, don't let the exam part mislead you. Think of this report less like a test and more like an incredible lens, offering a masterclass in how top financial minds apply complex concepts to tricky, real-world business challenges.
That's right. And what's so compelling here is that this report gives us a unique window into the actual thought process of financial experts. Yeah. It reveals not just where people might stumble on a formula perhaps or a calculation, but crucially, where they miss the much larger picture, the strategic, the ethical, the commercial implications that are truly the backbone of good business decisions.
Exactly. So our mission today is really to extract those vital nuggets of knowledge from this very real-world report. We want to show you what it takes to be truly well-informed in finance, not just by crunching numbers, but by developing a deep understanding of why those numbers matter, what questions you should be asking, and, how to apply critical thinking. You'll gain insights, I think, into the specific skills that elevate financial understanding from just technical competence to genuine financial acumen. So first, let's set the stage a bit. This isn't just about simple arithmetic. This advanced financial management assessment, it's structured around a large 50-mark compulsory question and then two 25-mark compulsory questions, all designed to test real-world application.
And this is where it gets really interesting, I feel, for anyone looking to build true financial expertise. Beyond just getting the right answer numerically, the report highlights what they call professional skills marks.
Wow.
Think of them as maybe the pillars of financial mastery. Clear communication, rigorous analysis and evaluation, a healthy dose of skepticism, and sharp commercial acumen. These aren't just academic buzzwords. They're the critical differentiators in, any real-world financial role.
Exactly. It means it's just not enough to simply solve the problem. You've got to present your findings clearly. You need to analyze the data deeply, challenge the underlying assumptions, and truly grasp the real-world business implications. It's about delivering the whole package. Okay, so our first deep dive. This comes from a scenario involving Compyco. They're a large listed machinery producer looking to acquire Skalco, a large unlisted company. And this isn't just about buying another business. It weaves in critical ethical and sustainability considerations right from the very start.
Right. The core of this challenge involves some pretty complex calculations. Things like estimating price to earnings ratios as PE, a common valuation metric, showing how much investors are willing to pay per dollar of earnings, along with additional equity value, and the percentage gain for shareholders under different offers, cash versus share for share. But, what truly stood out in the report, I thought, were the discussion points. That's where the real insight came to life.
Yes. That's where the art of financial management really comes into play, isn't it? First, let's unpack the acceptability of offers. The report showed it's not enough to just present your calculated gains. The real genius, it seems, comes from reading the room. You need to discuss why a cash offer might be preferred, for its certainty, or how a share-for-share deal triggers complex personal tax considerations for the selling shareholders. And crucially, did you compare your results to any desired premiums mentioned back in the scenario? That was key. And, beyond presenting the obvious, we often see a critical blind spot around assumptions. The report points out that merely stating, it is assumed the 4% annual cash flow growth rate is accurate, it just isn't enough. A truly insightful analysis would go further, questioning whether, and I quote, growth is in reality unlikely to progress so smoothly due to, for example, changes in economic conditions over time. Is this lack of questioning assumptions a common blind spot, even for, say, seasoned professionals? Or is it more something you see at the exam level?
That's a fantastic question. And honestly, you see it at all levels. Frankly, it's one of the hardest muscles to build that willingness to dig into the why not. If you need to. It's easy to just accept the inputs you're given, but true professional acumen comes from thinking about what could break that assumption. It's like building a house on sand if you don't question the ground beneath it. So many financial plans look solid on paper until the underlying assumptions shift significantly.
That's a great analogy, a really good one. And when we talk about the financial issues with cash offers, many only scratch the surface. They recognize the challenge of raising new debt, maybe, or having minimal cash. But the stronger answers, they delve into the ripple effects, like increased financial distress costs, or they considered alternative financing methods, raising new equity, perhaps, or selling off non-key assets. And finally, that ethical and sustainability layer. It added another crucial dimension. Co. planned to close a factory in a less developed area, one that produced hydrogen-powered vehicles. The report shows that while many candidates discussed the issues arising from negative comments, the stronger answers actually proposed actions, like maybe selling the factory to a third party or exploring a management buyout to proactively address those concerns.
Precisely. And what's particularly striking about this ethical aspect from an expert's view is that it's no longer just a nice to have. It really isn't. We're seeing real market and regulatory consequences for companies that don't proactively manage these reputational and societal impacts. It's moved, I think, from being simply about public relations into a core financial risk that absolutely must be mitigated.
Okay, good point. Let's switch gears then. Our next scenario involved Sobet Co. They needed to invest funds from an office building sale for 4 months, targeting a 4% return. But, and this is the kicker, they were anticipating a fall in central bank rates. This is a classic challenge in advanced risk management, interest rate hedging.
Yeah, the core technical task here was calculating the expected results of hedging using interest rate futures and options. And many candidates did quite well on the calculations themselves, but as we've seen, the real test came in applying those results to Sobet's specific business context.
So what does this all mean for you, the listener? Well, firstly, it's about seamlessly connecting calculations to the company's goals. The directors, remember, wanted a limited range of possible outcomes and that 4% return. Strong answers didn't just give a number. They discussed whether the chosen hedging method actually met these specific objectives. Surprisingly few actually compared their results directly to that 4% target. And then there's the power of options. The central bank base rate was volatile. That's a really crucial detail. Options, as you know, allow flexibility. You don't have to exercise them, which lets you potentially take advantage of favorable rate movements if the market shifts unexpectedly. That's a key insight that the good answers picked up on. Could you maybe expand a bit on why that flexibility is so critical in these volatile environments?
Absolutely. In a world where rates can swing, sometimes dramatically, having the choice that an option provides rather than the obligation you get with the future, well, it's gold, pure gold. It's about managing your downside risk while still retaining some upside potential. Many also overlooked questioning critical assumptions like, say, the absence of basis risk, that's the risk your hedge, doesn't perfectly match the underlying asset you're trying to protect, or even margin requirements. A truly robust analysis considers these, well, let's call them hidden costs and risks.
That's a powerful point. And it also goes beyond the basics to alternative hedging. Suggesting alternatives like a forward rate agreement or maybe a collar is good. But demonstrating commercial acumen means explaining why they might be a better choice, specifically in relation to this company's needs for predictable cash flow.
Right. And finally, understanding the market itself, specifically over-the-counter OTC versus exchange-traded options. There was often confusion here, it seems. Knowing that OTC options are customizable but might not have premiums versus exchange-traded ones which are standardized, they trade on an exchange. That's vital. It's about truly understanding the nuances of the financial tools at your disposal and how they map to specific client needs.
This really demonstrates that even with sophisticated tools, understanding the context and the client's specific needs is paramount, absolutely paramount. Being able to question assumptions, like the absence of basis risk or margin requirements, shows true skepticism and provides a far more robust analysis. It's about moving beyond just knowing how to use the tool, to knowing when and why it's the right tool for this specific job right now. Okay, our final deep dive then. This looks at GCR Co., a large railway services company facing potential franchise cancellations due to, well, poor performance. Here, it's all about assessing organizational performance using ratios and trends, but with a real-world edge to it.
Yes, this question was quite open-ended, which meant candidates really had to use their judgment, to choose the right ratios and structure their discussion effectively. It was a true test of their analytical capabilities, I think, beyond just crunching the numbers.
And for you, the learner, this is crucial for understanding how to truly evaluate a business in the real world. Many candidates, they could calculate ratios like profitability, liquidity, solvency. That's the baseline. But the strongest answers went beyond simply stating what a ratio showed. They explained the implications of the figures. They considered how different trends might interact. For example, what does a reducing profit margin specifically mean for a railway company that's facing contract issues? It's different, right? And a key differentiator was the importance of comparison. The scenario provided financial and operational info for a competitor, CTR. So calculating the same ratios for GCR as were provided for CTR, things like operating profit margin, gearing that made for a far more insightful comparison. It's one thing to know your own numbers. It's quite another to know how you stack up against the competition. And then there's identifying omissions. This was a critical part of the requirement, pinpointing what data was missing that would help extend the analysis. This is such a crucial skill for any financial professional, knowing when you don't have the full picture and what additional information you need to make a solid recommendation. It's a really strong example of applying skepticism in practice. How often, in your experience, do you find yourself needing to actively seek out those missing pieces, the things that aren't immediately presented?
Oh, constantly. It's practically every day.
Yeah.
A great financial analyst doesn't just work with what's given. They're inherently curious about what isn't being shown. That's often where the real risks, or sometimes even the opportunities, are hidden. So yes, identifying omissions isn't just some exam trick. It's really a cornerstone of critical thinking in finance.
Right. Okay, finally, commercial acumen in context. The report highlights that many discuss GCR's performance in just generic terms. However, the best answers, they connected the numbers directly to the railway industry context. They considered how reducing profit margins, increasing customer complaints, maybe a lack of capital investment, how all that specifically impacted a railway services operating company that's facing franchise cancellations. It's about tying the numbers to the actual story, the reality of the business.
And that connection to the bigger picture, to the industry, to the strategic reality of the business, that's where commercial acumen truly shines.
Yeah.
It really is. It's about moving from raw data to actionable business insights that actually drive real decisions. It's knowing, for instance, that a low liquidity ratio in a tech startup might mean something completely different than in a capital-intensive railway company like this one. Context is absolutely king.
So what have we learned from this deep dive into what it takes to master financial management? It seems pretty clear that true expertise goes far, far beyond merely calculating numbers or, memorizing formulas.
Indeed. It's about clear communication. It's about rigorous analysis and evaluation, and crucially, the ability to apply skepticism. So questioning assumptions, identifying gaps in commercial acumen, understanding the real-world business context and its implications. These are the skills, I believe, that transform a technician into a trusted advisor, someone who can genuinely add strategic value.
It really comes down to unlocking that deeper why behind the figures, doesn't it? It's about discerning the narrative the numbers are weaving and critically probing the very foundations of that story.
And that raises an important question for you listening to consider. The next time you encounter a financial report or perhaps a significant business decision, what assumptions will you actively question? And what commercial realities will you consider beyond just the raw data presented?
We hope this deep dive has given you a powerful shortcut, maybe, to being more well-informed and to thinking like a true financial expert.